Did you know that IRS can reject your payment plan request? Many taxpayers, they submit their payment plan request and they believe that IRS will accept it because IRS wants money. Why to refuse the payment plan proposal? Well, the IRS not always their businessman. They are thinking within their rules, and quite often IRS actually rejects the payment plan proposals, and it's not because of the tax balance that the taxpayer owes or whether the taxpayer has an ability to pay, but it's about what the taxpayer did or didn't do before proposing the payment plan to the IRS. I'm Olena Ruth. I'm tax resolution attorney, and I've been practicing in this area since 2010. And in this video, I will walk you through the most common reasons the IRS rejects or blocks your payment plan proposal, so you can fix the problem before you request the payment plan, rather than after you've been rejected. So why does it matter actually to know about the events that can be the reason for the rejection of your payment plan? Well, it's because there are several negative consequences that you would like to avoid to be successful in resolving your tax debt. First is that during their review of your payment plan proposal, the IRS tolls the collection statute of limitation, meaning it stops the collection statute of limitation from running. Collection statute of limitation is the period during which the IRS can collect your tax debt. It's usually 10 years. However, if you propose a payment plan and during that period when the IRS reviews it, the IRS actually stops the collection statute of limitation from running. Thus, if your payment plan is rejected, you pretty much extended your collection statute of limitation unnecessary without the reason. Second consequence is that after the IRS rejects your payment plan request, they actually can reinstate their enforced collection. Thus, they can start the levies and seizures, certainly given that the final notice, collection final notice is given. However, then you do not have enough time to fix the problem, or you need to enter negotiation with the IRS to ensure that the IRS provides time for you to fix the problem in order to provide the next payment plan proposal. Third negative consequence is that any rejection or every rejection that you have, it actually stays on with the IRS on the record. That's if you received a rejection and then you get back to the IRS, even if you fix the problem, the IRS actually will look into your history and they will see your previous rejections. Hopefully it's only one rejection, but even one rejection may be a negative factor in the IRS review whether to grant a payment plan for you. Thus, let's look into the most common reasons the IRS can reject your payment plan so you be prepared and fixing all the problems before you actually submit your payment plan request. The first and most common reason for rejected payment plans has nothing to do with your ability to pay, your balance that you owe. It's actually filing and payment compliance. Thus, if you have any delinquent tax returns, meaning returns that you did not file even though you were required to file, the IRS will not approve your payment plan request, period. What is the reasoning behind it? The IRS will actually ensure that when they set up a payment plan, they resolve your entire tax situation. Thus, if you do not have the tax return filed for the older year, they assume that potentially you owe the tax balance, and they would like that tax balance be included into the payment plan. Therefore, before they approve your payment plan proposal, they will request you file the tax returns. The similar rule is related to their payment compliance. So the IRS will actually look into the current year and see if you're a self-employed person that you pay self-employment taxes, or estimated taxes during the year, the current year when you actually request the payment plan. And if you are a wage earner, they will look into your pay stub and see whether you have enough withholdings. So then when you file your tax return next year, you do not have any balance. For the businesses, the biggest focus is on the payroll taxes. Thus, if the business is falling behind with payroll taxes, then the IRS calls it pyramiding the tax liability. And if the pyramiding is present under the IRS rules, the IRS will not approve the payment plan for the business until the business actually pays all the deposits, meaning will become current with the payroll taxes. So what is the fix to the problem? Well, file the tax returns. Now there are certain exceptions to that, and I will not cover those exceptions in this video. However, if you have any questions, please give us a call and I will explain and we will analyze your situation. And with respect to the payment compliance requirement, pay the estimated tax payments, the payroll taxes. And as soon as you can prove that you are in a current compliance with filing and payment, IRS will be ready to approve your payment plan proposal unless you have any other blocks. The second reason for rejected plans is actually surprises many taxpayers. The IRS can reject your payment plan proposal if, in their view, you can pay the balance in whole or in part. What I'm talking about is the IRS can request the taxpayer to liquidate the assets or use equity in assets before the IRS approves the payment plan. The reason behind this is that IRS believes that their taxpayer cannot accumulate wealth before they pay back taxes. So pay the taxes first, and then you can have savings. The biggest risk for this type of their block or the reason for rejected payment plan are liquidity assets. So example would be funds in a checking account, savings account, money market, and even retirement account. Yes, IRS can actually request you to liquidate your retirement account before they approve your payment plan. The similar rule applies to the equity in your assets. Giving you an example, if you have a rental property and rental property has an equity in it, IRS will look at the value, will look at the mortgage, the difference, and they will request that equity to be used to pay the back taxes. IRS can actually even reach your residence, although there is more limitation, it's more difficult to do. And it does not matter whether their equity or the asset will pay their balance in full or in part. They want it to be liquidated. So the biggest risk for this type of situation would be the balances over $50,000, because the balances over $50,000 require the financial disclosure that the IRS uses in order to determine whether the taxpayer has any assets that can be liquidated. Even worse situation is for the balances over $250,000, because this is a situation when IRS looks more closely at the financial statement. So let me give you an example. You have a balance of $100,000 and you have $80,000 in your savings bank account. The IRS will want you to liquidate $80,000, being paid that amount towards your back taxes before they actually approve your payment plan. Now, there's a catch. There's one exception. If you can demonstrate that liquidating an asset or using equity in your asset cause the economical hardship, meaning you will not be able to pay your living expenses if you liquidate that asset or use the equity, the IRS may agree not to require their asset being liquidated, and thus they may approve the payment plan. That being said, if your balance is over $50,000 and you believe that you have that asset that IRS will want to you to liquidate before they approve the payment plan, my recommendation is to have a consultation with a tax professional to ensure that you have all the arguments ready, or you prepare for their proposing the payment plan, in order not to be rejected just for the reason that you have some available equity that the IRS would want to use to pay the back taxes before they approve your payment plan. The third reason that the IRS can use to reject your payment plan proposal is the IRS determination that your payment plan was proposed to delay collection. The reasoning behind it is that when you make your proposal of the payment plan, the IRS, first of all, tolls the collection statute of limitation during the review process and cannot do any enforced collection during this process. Therefore, IRS always states that they want to work with the taxpayers that actually want in good faith to resolve the tax balance rather than filing their payment plan proposal in order to prevent any collection actions, but their proposal actually does not have any substance. That being said, the IRS determination can be relatively subjective. It depends on the IRS representative who reviews the file. And although some of their exceptions exist to this process and explanation in order to prevent the IRS to reject your payment plan, but the burden is on the taxpayer to provide the information to confirm or to verify that the payment plan proposal was made as a delayed tactic. Therefore, let's talk about three patterns of their alleged delay of collection behavior that the IRS has and set up in its rules. The first pattern is the repeated default of your payment plan. Thus, if you previously had several payment plans that you defaulted due to the missed monthly payment or a new balance, IRS will look into your history and may consider that they should not grant you another payment plan because your conduct already showed the repeated violation of the previously existing payment plan terms. Their way to fix this problem is to explain to the IRS what was the reason for previous defaults. For instance, it can be a change in your income, expenses, any life circumstances such as death in your family or potentially illness. But what you need to ensure is that you are prepared to provide this explanation and verification documents when you actually provide a payment plan proposal to the IRS to ensure that you do not get a rejection. Second pattern is when you propose an unreasonable terms of the payment plan. Usually it relates to the amount of the payment plan. For instance, you owe $200,000 to the IRS. The financial statement shows ability to pay of $5,000 per month, but you propose only $50 per month in payments. The IRS argument is that your payment plan proposal should correlate to your ability to pay. Therefore, when you make a payment plan proposal, you have to ensure that you understand how IRS computes ability to pay, what standards IRS uses, and what arguments actually can bring an exception to the case to allowance some expenses, or maybe an explanation that some income should not be considered as an income for purposes of computation of your ability to pay. The third pattern is when you resubmit your previously rejected payment plan without any change. For instance, previously you submitted a payment plan and the IRS wanted a verification, payment plan proposal, and the IRS asked for a verification of your housing expense. And in order to verify it, they ask for the copy of the rental agreement. However, you do not submit the rental agreement by the IRS deadline, and therefore IRS rejects the payment plan. If you submit the payment plan proposal a few months later under the same terms and without providing a copy of the rental agreement, the IRS will not take your proposal as serious, will not consider this proposal as a new proposal, and will reject it, or just simply will not review it. Therefore, in order to fix this problem, what you need to do, you need to ensure that you understand why your previous payment plan was rejected, what IRS required in order to have it approved, and make sure that you provide this information when you make your next proposal. The lesson from this to take is that the IRS actually has on the record all your rejected payment plans, defaulted payment plans, and also your previous conduct with respect to the providing documentation and information to the IRS. Therefore, you need to ensure that your record stays clean, that you are prepared when you make a payment plan proposal. And I want to emphasize that the reason delay of collection, the reason for rejection of your payment plan is delay of collection, is very serious. And if you have it already on the record, it will make significantly more difficult to submit the next payment plan proposal or in the future. Therefore, I highly recommend you to hire a tax professional if you already have this note on the record, or you assume or believe that you are in one of these three patterns of the taxpayer's conduct that can trigger the rejection based on delay of collection, or as IRS say, using the delay tactics. The fourth reason that the IRS can use to reject your payment plan proposal is incomplete financial disclosure. For the balances over $50,000, the IRS requires their full financial disclosure for exception of some of the cases. Their financial disclosure takes place on the Form 433 that has different versions depending on whether you're an individual, business, or self-employed, and this form called Collection Information Statement. Now, collection information statement, this is just the beginning of the review by the IRS of your proposal, because IRS also requires that you submit supporting documents with your statement. The supporting documents may include bank statements, credit card statements, the pay stubs, profit and loss statements. It could be statements supporting your expenses, a copy of the court order, and other documents that basically support the numbers on your financial statement. Now, the IRS may consider incomplete financial disclosure if they do not have the documents attached to the collection information statement. Now, that does not mean that the IRS will just reject your payment plan right up front if they do not have the documents. They still can give you an opportunity to provide additional documentation within a specific period of time. The IRS will set up a deadline, and if you do not submit the additional requested documentation by that deadline, they can reject your payment plan proposal. Now, be careful here as well, because even if you submit your collection information statement and supporting documents, IRS actually will match up the information that you provided on the statement with the supporting documents. And if they see some type of a conflict in the information, they can consider you as a person that lacks credibility, and therefore they consider the statement inaccurate and can reject the payment plan proposal. This is why the financial disclosure is actually the area where professional assistance will help you tremendously. And it's not only because their professional will know what documents to provide with your collection information statement, but also how to represent the information on your financial statement. The fifth group of the reasons for the IRS to reject your payment plan is purely procedural. In other words, your case is in the specific stage of the collection or other type of their IRS procedure that the IRS during this stage was not going to set up a payment plan. One of the examples of that reason would be if you filed for the bankruptcy and then you incurred post-petition tax liabilities, and you are trying to set up a payment plan for those post-petition tax liabilities. The IRS will not deal with you just because you are still staying in the bankruptcy. So you have to wait for the bankruptcy completion on TOCO to a specific department. The second situation is when you are trying to set up a payment plan over the phone or online. However, your case already been assigned to a local revenue officer. Most of the time, this situation happens to the businesses. And if your case is assigned to their local revenue officer, that collection is not going to touch it. The similar situation is with appeals. That's if you filed a request for collection due process hearing or collection appeal program, the IRS collection is not going to touch your case or set up a payment plan if you have your case assigned to a different unit. So this is just a procedurally, so you need to ensure that you understand where your case is and negotiate the payment plan with either appeals or after the bankruptcy is completed. So these are 6 categories of the events that can prevent you from getting an approval from the IRS for your payment plan proposal. Now remember, I will repeat once more that the IRS has all your communication on the record. They know about your defaulted payment plans, your rejected payment plans, your failure to comply with their filing tax returns, paying the taxes, particularly for the businesses pyramiding the taxes. Therefore, it is important that before you begin negotiation, you are actually prepared to provide the accurate information and to provide the information in addition to the standard requirements of the IRS. For instance, if you have changes in your income or expenses. And particularly, I will emphasize once more, if you have any situation where IRS alleges that you're trying to delay collection, contact the professional because it is important not to have on your record the collection delay notification. Please do not hesitate to contact me if you have any questions or you want to discuss your case. My contact information is in description below. Please do not forget to give me the likes and subscribe to my channel, and I will continue working on new videos to help you to deal with the IRS and other tax authorities on your own, or to understand when would be the best time to contact the tax professional. And I will see you soon.